Buongiorno. Buongiorno a tutti.
Good morning, ladies and gentlemen. My name is Massimo Gardi. I work for the Corriere della Sera in the United States, and I virtually always
Sono qui per
join this
introdurre
festival, and I'm here today to
Andy
introduce with
Haldane
great pleasure Mr.
in
Andy Haldane.
in questo incontro.
In addition to the traditional audience of the festival, today we also have a group of students from INET, this new initiative of the festival that focuses on international economy in cooperation with this international institute. I don't think I need to introduce to you Mr. Andy Haldane. He is an economist and member of the Central Bank of England. Although he is quite young, he is very well known for his work. He has been the person in charge of the office on the stability of the British financial system, but is also famous for his very sharp analysis and judgment of international financial situation and financial stability, and the need to fend off the risk of going through experiences like those of 2008 that led to the present crisis. So rather than describing Mr. Haldane's career, I wish to focus on some of his recent comments that raised a lot of discussion. We already spoke about the financial crisis, which started in 2008 in the past editions of this festival. And a few years ago, there was even a kind of trial organized to try indeed the financial institutions and central governments and so on. So it's a kind of fake trial. But I think it can be useful to stress again what was the origin of this crisis and the role of the central banks. And we may really ask ourselves whether a similar experience may happen again. 5 years ago, as probably you remember, the crisis started in the United States and spread all over the world, starting from the issue of the subprime money given to families in troubles. These companies began to go through a crisis. Initially, it seemed that the crisis might have been limited, but in March 2008, one of the major investment banks in Wall Street closed down and this happened in a night when Jamie Dimon, the head of JP Morgan Chase, was celebrating his anniversary in a Greek restaurant in New York, Gavra, an excellent restaurant indeed. And so during this celebration with his family, he received a call from the Federal Reserve asking him to take action immediately to save and spares and preserve the stability of the financial system. He decided to do so, although with some specific conditions, and the bank, the JP Morgan Chase, was going to play later on a key role in the international financial system. So for a few months, the system went on, but then, Lehman Brothers came along, and we all know what happened after that. Credit crunch and financial troubles for companies. Banks no longer trusted each other, and this led to a paralysis of the financial system. There was even the risk of going back to the Stone Age in the world of finance. Then central banks and the American government came along. There was a lot of discussion in the U.S. Whether the $900 billion given by President Obama to support the U.S. economy and bring it back to a situation of growth, unlike what happened in Europe, was the right choice. Certainly, the Federal Reserve took a very courageous attitude. It supported the banking system and saved many banks and gave them a huge wave of money at virtually no cost. And this, of course, brought about some very important distortions into the system, but it also gave banks the opportunity to make profit again and continue to play the role and finance the economy much more than is the case in Europe now. But this brought about some major imbalances. Many of these banks began to have some huge profits again, but the main reason is that they were directly or indirectly supported by the Federal Reserve and by governments. So that too is a matter of great discussion. There's a lot of discussion on whether this new balance is sustainable or whether some new action is needed to fend off the risk of going back to a situation similar to the one of 2008. The financial market is still very complex. Creative finance, the great market of derivatives and fake financial products is still there, and the figures are still rocketing. So in an attempt to address all these problems in the United States, some 3 years ago, in July 2010, a reform was passed that was meant to prevent similar situations to happen and avoid that banks that were too big to fail would create a terrible imbalance in the system. Although other people feel that this reform is too complex or has not been applied sufficiently, and so it is not very effective. More recent data, more recently, two MPs, Shell Brown and Bitter, put forward a proposal in the United States which addresses this problem of the too big to fail. In accordance with this proposal, big banks don't have to break down, but those that have over $500 million assets to double the reserves that may be needed in times of crisis, bringing them up to 15%. That's, of course, a major effort. They should set aside $1,200 billion. So these big banks are doing all they can to prevent this from happening, claiming that this is discrimination against them. But in fact, it's an attempt to try to almost force them to break down into smaller units. The market is aware that these banks are too big to fail, and the result is that they receive funding at lower rates than small banks do. So in a way, it's safer to put your money in one of those banks, because even in the situation of future crisis, it's going to be saved by the government to protect the economy. Now, let me go back to Mr. Haldane. 1 year ago, Andy Haldane spoke at the seminar of central bankers held in August, end of August each year in Wyoming, in a city that is a bit like a Trento in the far west. It's a mountain place, in a wonderful place where people go skiing in the winter, with ranches and buffaloes, and it's a very suggestive place where bankers get some privacy. There are not many journalists there, and they discuss the international financial situation once a year. And last year, Andy Haldane had a key role during that event. They wanted to get some new and provocative idea from him, which he duly did, indeed, and he explained that, in his opinion, the great, immense complexity of the financial system has been opposed so far by the regulators through an equally complex set of rules. In his very long report, and I have a copy here, but I'm not going to read it, of course, and Andy Haldane is going to focus on some of the same topics today, but he gave a very detailed description of this matter using algorithms and complex things, and he gave his report a very technical title, The Dog and the Frisbee. But the point he was making there is that getting a frisbee is very difficult. You need to know its trajectory, which is influenced by the climate, by the wind speed, by the frisbee rotation speed. And a man who has all this knowledge is less skillful than a man in the end, less skillful than a dog. All of this means that very often you don't need to try to find complex solutions to complex problems. At the end of his presentation, of his report there, he said, and I wish to make a small quotation, he said, the rules in modern finance are complex, perhaps too complex, and this is a major challenge for us. You cannot put off a fire using fire. You cannot fight against complexity with complexity. Complexity brings about uncertainty and not risk, and it requires regulators to develop simple rules. In his report, he gave some important facts and figures. The Glass-Steagall Act, for example, that provided the solution to the Great Depression in 1929 was an act of 37 pages. The rule of Basel I, again, was very short. In the case of Basel II, it was just a little bit more, some 100 pages. Then Basel III became a document of 800 pages. The U.S. Dodd-Frank Act is 800,000 documents, and the implementation description will require some 30,000 pages. In the opinion of Andy Haldane, this tower is really like the Babel Tower. The Babel Tower and the Babel Tower are very close to each other. So what I will do is I would ask Haldane to illustrate these issues for us, and whether we've done some progress with our attitude with the banks that are too big to fail, or whether we're running the risk of going back to a situation comparable to that of 2008, the most terrible crisis in the past 80 years.
Thank you. Thank you, Massimo. Can you all hear me? For that kind introduction. I didn't actually understand most of it, so I can only assume it was kind. The only words I did pick up, rather disconcertingly, were Jamie Dimon and Frisbee. Anyway, it's a huge pleasure to be here at the Trento Festival, a celebration, a real celebration of economics. And it's a particular pleasure to be giving one of the INET lectures, because INET is committed to celebrating new economic thinking. And there has never been a better time in the past century for some new economic thinking. I had planned to talk about growth, but when I thought about it, I couldn't resist instead turning to the question of banking and to the question of the banking crisis, given that I was speaking here in Italy. I'm going to stand up and actually probably involve one or two of the audience as well to make it easier on me. Hands up, who's here from the INET Young Scholars? Good, well identified yourself. So why do you think there's a natural link between banking and Italy? Why is it appropriate that here in Italy? Who is that? It started here. Italy is the... I can't hear what you're saying, but I'm sure you're right. I'm sure you're right. Italy, as you say, the mother of banking. Modern banking was born here, to the west of here, actually, in Lombardy in the 13th century, and then spread all over the place, including to London, including to where I work at the Bank of England. In fact, the most famous street in the City of London, in the financial centre, anyone have a guess? I'm going to ask, actually, where's Perry? Perry, if any man in the room knows the name of the most famous banking street in London, it is Perry Merling. Is Lombard Street. Lombard Street. Named, of course, after the Lombardy region, which was the birthplace of modern banking. So, next question. Who or what, this one's harder, who or what is celebrating its 450th anniversary this year? Anyone? Anyone?
Not Monte dei Paschi di Siena Bank. Don't.
Not what I have in my head, but you might well be right. It's as I understand it, the 450th anniversary of the last meeting of the Council of Trent. The Council of Trent, who I only knew this fact yesterday, someone told me, let me not... but the Council of Trent that provided the intellectual foundations of the Counter-Reformation. So I thought, what better place than this spectacular 16th century Palazzo Geremia in Trento, the very heart of the Counter-Reformation. In Italy, the very heart of banking. What better place to talk about the Counter-Reformation in banking that we need? And today, the Counter-Reformation starts here, in this room. I will start it off, and you, I think, will be left to finish it. It may take some years, but if we start today, it gives us a real opportunity. And crises are a real opportunity. So in Mandarin, as many of you probably know, the word crisis breaks down into challenge, and there have been plenty of challenges over the last 4 or 5 years, and equally importantly, opportunity. Opportunity. And there are opportunities right now to rethink our models, our economy, our banking system from pretty much a clean sheet of paper. And what better place to do it than here? And this is why it matters. This is why it matters. This chart just looks at the path of output in 3 country blocks, the UK, the US, and the middle block is the euro area. The colored line is GDP in those countries. The black line is the pre-crisis trend in GDP in those countries. The key point for you to take away is to observe at just how costly in lost output this crisis has been. Already, 5 years on, most economies, most Western economies, are operating with output 10% or more below where it would have been had we not had the crisis. Here in Italy, in Europe, output is still below where it was when the crisis first broke in 2008. If we added up the cumulative loss of output so far and looking forward, this will end up costing us more than a year's annual output. Nothing compares in terms of economic events to financial crises, and few financial crises compare with that which we've been living through over the past few years. This is why it is so important we do something to prevent a repetition if we can. So, what is it about banking that has gone most wrong? What are the biggest problems it has encountered? Well, they have been many and various, but there's one in particular I want to focus on today. And to bridge to that, I want first to have a little quiz involving the audience again. This quiz is odd one out. So there's 3 pictures, and your job as the audience is to tell me which of those is the odd one out. Let's start just by naming them so we all know what we've got in front of us. And let's start here. Would anyone like to have a guess about who that is? It's King Kong. Thank you. I was here, sorry. I missed your... Well done. Marshall, well done, well done, well done. You a fan of King Kong? You're a fan of King Kong. Okay, that one's easiest. Maybe the easiest. This is the trickiest, the middle one. Does anyone know what this is? Godzilla. Very good, very good. Who said that? Was that here? Are you a Godzilla fan, sir? You look like a Godzilla fan. No, it's impressive. So then moving along, this one, anyone? Mario Draghi, was that, Rob? No, maybe Mario. I doubt that is Mario, actually. This is Father Christmas. Very good. Well done, well done. So these are the 3. And one of these is the odd one out. Would anyone like to have a guess which is the odd one out? Yeah.
I think it's Godzilla, because it's not a mammal.
Not a mammal. So it's an answer that's difficult to argue with. It's a good answer. It's not the right answer. I'm sorry. Anyone else like to have a stab at which is the odd one out? Sir. He has clothes on. That is also difficult to argue with. And actually, you have got the answer right, even though you've got the reason wrong. The odd one out. And the reason Father Christmas is the odd one out is because Father Christmas could exist. He doesn't exist, and I'm sorry if that's a surprise to anyone in the room. But he could exist. He could exist. Whereas King Kong and Godzilla, they couldn't exist. They're physiologically impossible, right? So given their body mass, if King Kong or Godzilla were to take one step forward, the weight of their body would snap their thigh bone, and they would collapse under their own weight. So that they're physiologically impossible. Why is any of this relevant to banking? Is the question many of you are probably asking yourselves. And it's because many of the world's biggest banks would also be physiologically impossible were it not for state support. They too would have collapsed under their own weight if they'd taken one step forward, had it not been there for governments to catch them. This is the problem of too big to fail, that when these Godzillas and King Kongs in 2008 risked collapsing under their own weight, government was forced to ride to the rescue, to stop them failing. And this gave birth to what has become known as the too big to fail problem. And we fast forward from 2008, and we saw a new manifestation of this problem, which is as governments rode to the rescue and as output collapsed, we saw government balance sheets coming under pressure. We moved from a situation of too big to fail to too big to bail, too big to bail out, which is why we found countries such as Iceland or Ireland or Spain or Greece or Cyprus finding themselves in the acute problems they found themselves, with oversized banks and oversized banking systems bearing down on the government finances and ultimately blowing them up. And during the course of the last 12 months, we have had a third manifestation of this problem. We had too big to fail. We then generated too big to bail. We now have too big to jail, with questions being asked about whether we can indeed bring to justice those that have run our big banks, in many cases, into the ground. So whether it's too big to fail or bail or jail, the key thing is that at present, many of our global banks, the banks that dominate our financial system, are too big. And what I'd like to do today is tell you a story about how it was we arrived at this position. That's the first thing. Secondly, what has been done so far to tackle this problem? What have me and my colleagues in the regulatory community been doing to get our arms around these financial leviathans? And thirdly, what more might be needed to finish the job, to crack this, the hardest nut we have faced during the course of the financial crisis. I want to conclude that more does need to be done. More has to be done because quite literally, we cannot afford to have a crisis on this same scale in the near future. So, that's the plan. And let me start with how we got here. How did we get here? What this chart does is look at the ratio of total bank assets, the total size of their balance sheet, if you like, in relation to annual GDP in a selection of 14 countries over a lengthy period of time, over the last 140 years or so. The orange swathe shows the cross-country variation. But if you take the average, which is the blue line, what has been happening? Well, in the main, this blue line has trended inexorably upwards. So banks' balance sheets in relation to incomes have gone up. The banks collectively have got bigger. Particularly so, you'll see, after around 1970. So if you take for about 100 years, from 1870 to 1970, there was a financial deepening. Bank assets relative to GDP were increasing at around 0.5 percentage point per year, the ratio. After 1970, big financial liberalizations, and this ratio of assets to GDP started growing at more like 3 percentage points per year, 6 times the rate in the preceding century. Now, typically, economists think that this sort of pattern ought to be a pretty positive one. We use the word financial depth to describe this trend, and typically we think of financial depth as being a good thing for growth. It enables a greater number of households and companies to get access to credit, which in the past they may not have had access to. And up until a couple of years ago, most of the evidence, the empirical evidence, looking across a large number of countries, suggested that indeed that intuition was right, that greater financial depth helped boost medium-term growth. But, and the but is very important, over the last couple of years, that orthodoxy that financial depth equals higher growth has begun to be questioned. In particular, a number of bits of empirical evidence have suggested that there are limits, there are thresholds beyond which this positive relationship between finance and growth begins to break down. Indeed, not just break down, but reverse sign. That banking can become too big. You can have too much of a good thing in a way that acts to retard growth, not promote it. So here's a picture of, if I press the right button, of one of these empirical studies, the relationship they have plotted between, this is private sector credit, bank assets to GDP running horizontally, and then running vertically is a measure of productivity in the economy, sort of outputs per unit of inputs. So a higher number is higher productivity, which is good, and a lower or negative number is bad. What are the key points here? Well, you see that this relationship, based upon evidence from a whole set of countries and across a long period of time, suggests this actually pretty U-shaped, reverse U-shaped pattern, this hump pattern. So indeed, financial depth can be productivity enhancing within limits, but you can indeed have too much of a good thing, and if banking gets too big, you might even find productivity being certainly slowing down and possibly even being negatively affected. Why might that be? Well, because if banking gets too big, it drains resources prospectively away from other sectors of the economy. It could drain labor away from the non-financial economy. It could drain financial capital away from the non-financial economy, and could indeed be bad for growth. So banking, too big? Question mark. What is certainly true is that banking has become more concentrated. So this rising tide of banking assets is being held by an increasingly concentrated set of big banks. So this picture looks at the share of total banking assets accounted for by the three largest institutions in the countries concerned. So in the UK, in Germany, and Switzerland, the three biggest banks account for anywhere between 2/3 and 3/4 of all assets. A very concentrated system. And even in the US, which is the blue line here, where concentration is somewhat less, it has increased very dramatically over the last 20 years or so. In 1990, the three biggest US banks accounted for only 10 to 15% of total assets. Today, that number is around 40% or more. So the total size of the banking pie has got a whole lot bigger, but the share accounted for by the largest banks has, at the same time, also grown. And if you're saying, well, size isn't everything, that is indeed true. But it's not just size, it's also concentration and complexity. This takes some of the biggest banks in the world and looks at the number of distinct subsidiaries they have, the number of legal entities that they contain, the number of countries they operate in, and the size of their balance sheets. These big global banks are fiendishly complex. They have often thousands of distinct legal entities. They operate in dozens, sometimes hundreds of countries. They have a balance sheet which is larger than the annual output of Italy. These really are mammoth entities. And therein lies the problem when they get into trouble. Because whether it's too big or too complex or too concentrated, events of the last few years have illustrated that it's very difficult for a government to stand aside and let these large entities fail. And just think through what that means. What does that mean? Imagine everyone recognizes that the government will ride to the rescue. What will result? Well, that will mean that investors in those banks feel pretty happy. They can get all of the upside and none of the downside. Because they know if the bank fails, the government will be there to catch them. Their investment is less risky. A less risky asset will be provided more cheaply. So the funding costs of the largest banks will fall. Lower funding costs for banks mean bigger profits for banks. So the biggest banks, the ones with the strongest expectations of state support, will have lower funding costs, larger profits, and that will, of course, encourage them to get larger still. We find ourselves on an evolutionary trajectory in which the big become progressively bigger because of that too big to fail problem, because of the expectation of state support. And these expectations, this implicit guarantee of the biggest bank, of the biggest banks, can be very sizable. Here is one measure of it. So the rating agencies, which typically no one likes, do at least do one useful thing. Maybe more than one, but certainly at least one. They provide for the banks two measures of their creditworthiness, okay? They provide one measure, one rating, assuming that the bank would be allowed to fail, the standalone rating. But they also provide a second rating, which is the one that matters, which is the rating that embeds an assumption about whether this bank will be bailed out by the government. And that's called the support rating. So the difference between these two ratings, the standalone rating and the support rating, provides the rating agencies, the financial markets, best guess of whether this bank will be bailed out. And that's what the blue line here shows. It looks at the difference between these two ratings, how much of a ratings uplift, how much lower are the funding costs for the biggest banks in the world because of this expectation of state support. So what we see here is up until around 2007, the crisis broke, this expectation of state support, this implicit guarantee, was worth just over one notch in ratings. And then after the crisis, as that implicit support became explicit, banks were bailed out, the rating agencies revised up their expectation of the likelihood of banks being bailed out, and therefore this additional rating support from being too big to fail went from around 1 and a bit notches to around 3 notches. So what? That doesn't sound much on the face of it, but let's now translate those differences, those implicit subsidies, if you like, to the biggest banks from the government into some concrete numbers, some real numbers that we might recognize. This is for the 29 biggest banks in the world. And this is then a measure of the implicit financial subsidy extended to these banks over this period. So again, let's break it down. Prior to the crisis, that too big to fail guarantee was worth, for the big banks, on average, around $50 billion every year. Every year. So to put that in context, that's almost half of the profits earned by those banks in the pre-crisis period. Could be accounted for by these implicit government subsidies. And of course, after the crisis, when those implicit subsidies became explicit, we find the corresponding subsidy shoots up very dramatically and, interestingly, has remained at those higher levels. So today, that implicit support, that implicit guarantee to the world's biggest banks is worth to them several hundreds of billions of US dollars, which is actually well in excess of the profits that they earn on an annual basis. And even if you don't buy very precisely the numbers, you'll see the orders of magnitude are such that this is a very big deal for governments and a big deal for the banks that are the recipient of these subsidies. What it does is to lock governments and banks in this deadly embrace, where government feels duty-bound to ride to the rescue, even if it means endangering their own balance sheet, as we found in Iceland and Ireland and Spain and Greece and Cyprus and whoever is to come next. We get locked into what elsewhere I have called a doom loop, in this feedback and interaction between an oversized banking system on the one hand and a potentially bankrupt government on the other. Just look at the way in which the government debt to GDP ratio in the major economies has shot up over the last few years. One of the tangible costs of this doom loop between banking and sovereign states. So that's the evolutionary trajectory. That is the problem. That is the key structural fault line in the global financial system. How are we to tackle it? I want to discuss 3 sets of initiative that have been put in place over the course of the last 5 years to try and crack this nut. I want to talk about additional capital being put in to the world's biggest banks. I want to talk about resolution regimes, means of liquidating the biggest banks in an orderly fashion. And I want to talk about so-called structural measures, measures to prise apart the balance sheet of banks to make them safer. Because those are the 3 strands where there's been most policy progress over the last 5 years. Starting with what I'm going to call systemic surcharges. So what does this mean? So you often hear economists talking about these things called externalities. And simply put, they are just bad outcomes created within society, which those contributing to those bad outcomes don't take fully into account. So the classic example, pollution, okay? So I'm a factory, I am polluting the atmosphere. That leads to a collectively worse outcome for everyone, but I don't fully take into account the effects of my own polluting actions on broader society. So pollution is a classic externality, and so too is risk across the system. That too is an externality. Those biggest banks aren't fully taking into account the damage their failure would do to society. If they were, government wouldn't need to ride to the rescue. So systemic risk is an externality, and for several hundred years, economists have had a ready-made solution to this externality problem, and it's to tax it. It's to impose what economists called a Pigouvian tax, after the classical economist Pigou. To tax it to such an extent that there are no longer incentives to pollute, to create systemic risk. And somewhat remarkably, the microeconomic theory has found its way into regulatory practice over the last 2 or 3 years. The world's regulators have taken this message to heart and said, yes, what we need is a tax, a systemic risk tax, a systemic surcharge imposed on the world's biggest banks. And the form this tax will take is by requiring them to hold a bigger cushion of rainy day reserves, what regulators call capital. Will require a surcharge of extra capital to reduce the chances of them going bust and us as governments finding ourselves on the hook. And that's exactly what's happened. Rather remarkably, that economic theory has found its way onto the statute books very quickly. And we're now going to require from the world's biggest banks extra cushions of capital up to 2.5% of their balance sheet. So directionally, this is right. Extra capital means lower risk, means less chance of government being on the hook. The problem is the size of this tax. 2.5% of capital isn't really all that much. I mean, bear in mind that we're talking about institutions that are financed with around 98% debt on average. They're 98% debt financed, right? So requiring that they go from 98 to perhaps 96 or 97 isn't such a big leap and doesn't have such a big impact on the chances of them failing. This is a slightly complicated chart, which I won't labor, but it's a simulation for the economists in the room. It's a simulation of the probability of those big 29 banks going bust, drawn from a little contingent claims framework. And it asks, how much are expected losses across the system reduced by systemic surcharges, measured horizontally, being of varying sizes? Just take the yellow line for a second. What that basically tells us is that, a surcharge up to 2.5%, the dotted line, does help lower those expected losses quite a bit, but there's still a whole chunk, indeed $300 billion worth of a chunk, left untouched with capital surcharges set at those levels. Is this progress? Yes. Is this sufficient to rid us of the problem of too big to fail? Absolutely not. Why was it regulators didn't choose a number bigger than 2.5%? I've got some good stories as to why that is, but I'll tell you them privately. The second attempt we have made to do a better job of handling these big banks is to try and put in place arrangements so that when they do fail, when they do stumble, when they do fall, instead of writing a check and bailing them out, we instead put them into a special form of bankruptcy. We treat them in the same way as we would any other non-financial firm. We let them go bust, but we do that in an orderly fashion, in a way that doesn't bring the ceiling down, in a way that doesn't lead to GDP falling off that cliff that I showed you in the slide at the beginning. And this, too, has seen some real regulatory progress over the last few years. The first mover here was in the US, and the Dodd-Frank Act that Massimo mentioned. What does that do? Well, it identifies those firms that are the greatest source of risk. It says whether those firms are banks or non-banks, they will be subject to these special bankruptcy arrangements. It says we will legally prohibit ourselves from bailing these guys out in future. And it says that to make good the losses these big banks face, we won't bail out, we will instead bail in the creditors of these firms. We'll impose losses on the investors in banks rather than on us taxpayers. And the essential logic, the principles underlying that general approach have now been agreed globally by this thing called the Financial Stability Board. And here within Europe, we're in the process over the next few months of putting in place a regulatory directive which will enshrine this statutorily within Europe as well as in the US and elsewhere. So, So far, so good. Is this the answer to our prayers? Is this, as some have suggested, the solution to the too big to fail problem? No. No, or not yet, at least, for two reasons. How is it that we deal with a big bank? Let's take a huge bank. Let's take, Massimo mentioned JP Morgan. Let's do JP Morgan, the world's biggest bank. It is failing. There are two ways of dealing with the failure of someone as big as JP Morgan. One would be to take its assets and its deposits and sell them on to someone else. Okay? To sack the management, strip the assets and the liabilities, and to sell them to someone else. And indeed, that was the way a number of the larger banks were dealt with during the course of the crisis. So when Bear Stearns failed, it was sold to JP Morgan. And when Merrill Lynch stumbled, they were sold to Bank of America. When Washington Mutual failed, they were handed on to Citibank. On the face of it, this sounds okay. But just think about what that does to the evolutionary trajectory of the financial system. The only bank capable of buying, of digesting a big bank is another big bank, which means that the biggest banks become larger still, and the too big to fail problem becomes ever more acute over time. And interestingly, during the course of this crisis, we've seen the degree of concentration in the financial system become greater, not lesser. The too big to fail problem has worsened. So there are natural limits to, I think, how far we can go in this splitting up and selling approach to dealing with the big banks. It works like a dream for the small banks. For the big banks, it won't work. It can't work if we're serious about reducing, not increasing, concentration. So, if not selling, what else could be done? Well, the other solution, the one I mentioned, is to not bail out, but instead to bail in. There's lots of talk globally now about this being the solution to all of our prayers. When push comes to shove, when problems strike, all we do is hand the bill to the creditors of the bank in question. And we say things like, it's very important that we protect taxpayers and make investors pay. This all sounds terrific. This sounds fantastic on paper. But the fact is, crises are not fought on paper. So put yourselves in the shoes of the finance ministry or the treasury secretary of the day. And a big bank comes knocking at your door. And it says, bad news, I'm bust. I'm bust. You have, finance minister, treasury secretary, you have two options. You could bail in all our creditors, you could bail them in if you wanted to. By the way, they're all pension funds and insurance companies. I imagine they may come knocking on your door when you tell them that their pension is worth half the amount it was previously, or their insurance claim is worth half the amount it was previously. By the way, remember when you bailed in Lehman Brothers, how well that went, and you almost brought the world to an end? That's one option, finance minister. And the second one is that you write the check. And faced with that dilemma, faced with that time consistency problem, it strikes me as very likely, indeed almost inevitable, that whoever it is, they will blink and take the second option. If I were them, that's what I would do. And that's not conjecture. That's because That is what has happened on every occasion, pretty much every occasion on history, where a Treasury Secretary or Finance Minister has been faced with that dilemma. And in some ways, part of me thinks there's some logic to it. Because what you do in writing the check is to smooth out the pain. You spread it across a wide range of taxpayers rather than a narrow range. And you spread it between today and tomorrow. You smooth it out. And if I'm a politician or a finance minister or a treasury secretary or need a central bank governor, I might quite like to smooth the pain out. And that being the case, there's a decent chance that I will do the right thing, which is to reach for the checkbook and to bail out rather than to bail in. History tells us that is what has happened. And the rating agencies tell us that's still what they expect to happen. So I mentioned this Dodd-Frank Act, which in principle takes the checkbook, the government checkbook, and tears it up, says never again. I will never again bail out a big bank in America. Instead, I will bail in creditors. So let's ask the question, has the passage of the Dodd-Frank Act, the dotted line there, made any material difference to the likelihood of a bailout happening? Well, not really. In fact, the expectations of a bailout today, even in a post-Dodd-Frank world, are higher, underlined, higher than they were before the crisis struck. Rating agencies, market participants, central bankers recognize the importance of incentives. However you write the legal rules ex ante, what matters are incentives, are behaviors ex post. We need, if we are to solve this problem, to solve that incentives problem. If Too Big to Fail had a legal solution, we'd have solved it a long time ago. It's all about incentives. Which takes me to the third strand of reform, which is meant to speak to this incentives problem. It says, well, if we can't wind a bank down in an orderly fashion, and if we haven't done enough to prevent them failing, why don't we act directly on the structure of banking? Put in place so-called structural reforms. There have been many versions of these. I've listed some of those down here. There's the Volcker rule that some of you may have mentioned in the US. We have proposals in the UK called the Vickers Plan. There are proposals across Europe put forward by this guy called Erkki Liikanen, which would also affect the structure of banking within Europe. Lots of progress on this front over the last few years. I won't go through the detail, but these three proposals differ in their detail. They're all about separating out or ring-fencing the risky bits that we often call investment banking from the less risky bits, which we sometimes called retail banking. But they achieve that separation in slightly different ways, and they put the ring fence in slightly different locations. But in essence, all three of those proposals are doing something broadly similar. Why? To make it somewhat simpler, somewhat easier to keep the good bits of banking, the retail bits of banking, safe and sound, and to allow the risky bits of banking, the less good bits, to be wound down safely without fear of cross-contamination between the sheep and the wolves. These are proposals for separating out, ring-fencing the wolves in the investment banking world from the sheep in the commercial banking world, the good bits from the bad, to put it very crudely. And you might just see, why is it we might want to do that? Well, these are quite different beasts. Wolves and sheep are quite different animals and have paid themselves rather different amounts of bonuses over time. This chart speaks to that. Looks at the wages in a selection of sectors. So the green line is this good bit of retail banking, commercial banking. The orange line looks at wages in the insurance sector. And this blue line captures, effectively, investment banking. It's quite a striking picture. So back in 1980, your average professional person with equivalent qualifications would be paid the same in investment banking as they were in commercial banking, as they were in insurance, as they would be in law or medicine. All professions paid roughly the same multiple, which is why this is around 1. This number's around 1 for all those sectors. Over the following 30 years or so, however, something pretty extraordinary happened. I mean, the bankers started paying themselves a bit more than their professional equivalents in law and medicine, as did the insurance company people. But the investment bankers made out like bandits. 30 years on, they were being paid 4 times the amount of their equivalently skilled professionals in other industries. A pretty dramatic cultural shift, which generated pretty dramatic differences in risk culture, in risk-taking culture. So, the notion behind these ring-fencing proposals is to try and achieve a separation of balance sheet as well as separation of culture, given how differently they pay themselves. Will these structural proposals work? We do not know. Those of you familiar with the US debate will know that they are facing real difficulties in implementing this thing called the Volcker rule. Here in Europe, will Europe enact any type of structural reform to its banking system? Will these Liikanen proposals find fruit? That remains a big question, but many people within Europe are skeptical that, for example, France or Germany would turn its back on its universal banking model. There's a healthy degree of skepticism that structural reform proposals of these types will solve the too big to fail problem. I come back to this chart, which is what the market thinks today about whether we have solved too big to fail. It is concluding pretty decisively this problem is, if anything, worse than when the crisis commenced. And why is that? Because banks are even bigger. They're even more concentrated. They are ever more complex. The implicit subsidies that generate this doom loop are even larger. These beasts, be it King Kong or Godzilla, but not Father Christmas, remember, have not as yet been tamed. And that's why the debate about too big to fail has taken a new turn. There has been a growing recognition over the last 6 to 9 months, starting in the US and gradually percolating outwards, that this problem has not been solved. And that's meant that several proposals, more radical proposals, have been put forward for tackling and taming those beasts. I've mentioned 1 or 2 of them here. So there's a very active debate, actually, within the US right now, about whether we should require the biggest banks on the planet to hold not just a little bit more of this thing called capital, but a lot more. So the most radical of those proposals are by these two US senators, Sherrod Brown and David Vitter, who have proposed a leverage ratio, I won't bore you with the detail of that, a leverage ratio of 15%, which is basically 5 times larger than is currently required by international regulation. In other words, a lot more capital for the world's biggest banks, those with balance sheets in excess of $500 billion in assets. Others have said, well, capital's one thing, but why don't we just place some caps on these guys? Let's just say you can't be bigger than X. Impose some explicit size limits. And this isn't just the crazies in academia saying this. It's been an idea that's been mooted within parts of the official sector, the Federal Reserve System in the US too. There are those that say we ought to turn back the clock and reimpose something that achieves proper separation, not just ring fencing, but proper separation between, say, retail and investment banking, a return to what some of you may have come across as the Glass-Steagall Act provisions of 1933. All three of these radical proposals for tackling too big to fail are back firmly on the table. But the big question each of them poses is, what are the costs from this more radical course? What are we losing if we, for example, impose size limits on banks? And the most natural argument that's often used about what we might lose is that we then remove the possibility of so-called economies of scale or economies of scope. In other words, bigger banks do a better job of spreading the costs out and therefore can be maybe more productive than smaller banks. Or that by diversifying across activities, that leads to lower risk among the bigger banks. So these are the economies of scale or scope that the biggest banks have argued would be lost if we were to pursue some of these more radical proposals. So what do we make of those arguments? Are those compelling reasons not to pursue these more radical options? What is the evidence on these economies of scale or scope in banking? Well, this summarizes it. There's surprisingly little evidence, actually, on whether there are economies of scale or scope in banking. But I've summarized roughly where it comes out here. In the 1980s, there were a set of papers that argued that it was pretty tough to make a case for economies of scale for banks that had more than $100 million in assets. In other words, very small. In the 1990s, there were a set of papers that pushed that threshold up. They said, yes, those economies of scale were there, but appear to cease at an asset size of around $10 billion. None of these studies at this stage were music to the ears of the big banks, because these thresholds were much, much less than their scale even then. Fortunately, there's been some papers over the last 2 or 3 years that have pointed to a more optimistic conclusion for the biggest banks. They've found economies of scale for banks with balance sheets well in excess of $100 billion. Indeed, some have found economies of scale for banks with balance sheets as large as the largest bank in the world. In other words, economies of scale, even when assets are $1.5–2 trillion in size. And this is that evidence. So I've taken their studies and replicated them across the horizontal axis. This shows the total asset size of a variety of banks. So these are banks with assets less than 100 billion. These are banks with assets of more than $2 trillion in assets, and the ones in between. So bank asset size is increasing, coming up here. What are these blobs showing? Where they're showing a measure of whether there are indeed economies of scale in banks of different sizes. So along the, if these blobs lie above the dotted line, what it's saying is that there are economies of scale. There are increasing returns to scale in banking. By doubling the inputs into banking, we can more than double the outputs. And because these green blobs lie above the line rather than below the line, we conclude there are increasing returns to scale. There are economies of scale in banking, which, if anything, increase with size. So taken at face value, this would suggest that we might well be throwing away something rather important if we were to size cap the biggest global banks. But, and there is a very important but, what these studies fail to take proper account of, indeed any account of, is the fact that these self-same institutions all benefit from that government guarantee I mentioned at the beginning. Remember that? Remember the doom loop? Remember the implicit support? Remember the implicit subsidies? So what do? So implicit subsidies make big banks less risky because of the guarantee. That lowers their funding costs. That boosts their profits, and therefore would show up as greater value added for the bigger banks than is in fact the case. It would distort upwards any measures of economies of scale from studies such as these. So we shouldn't really take these studies too seriously unless they take proper account of that government guarantee. When you do that, what happens? That's what happens. So you flip that round, you do your econometrics properly, you take proper account of these government guarantees, these subsidies. And what do we find? Well, we now find that these now purple dots are not above the line, increasing returns to scale, but are instead below the line. That is to say, decreasing returns to scale. And what's more, size, if anything, tends to make those decreasing returns more acute rather than less acute. We don't have an efficiency loss, we prospectively have an efficiency gain from capping size. Why might that be? Well, because alongside too big to fail or too big to bail or too big to jail, we also have the problem of too big to manage. And it's that incapacity to manage a balance sheet bigger than the annual GDP of Italy, with 2,000 subsidiaries operating in dozens or hundreds of countries, that might generate just those dis-economies. So, where are we? We've seen an evolutionary path for banking over more than a century, which has generated not just bigger banking, but bigger banks, more concentrated banks, more complex banks, and the government finding itself progressively on the hook for supporting those Godzillas, those King Kongs, when they fail, and therefore generating incentives for the largest banks to become larger still. The last 4 or 5 years have seen a dramatic set of interventions by regulators like me to try and solve that problem. We have tried, but on the basis of the evidence so far, our job remains unfinished. This counter-reformation in banking that I said we should start today is unfinished business. It will not be people like me, old and tired and wizened, who will complete the job. Completing the job will fall to you, and I wish you all well in that. Thank you.
Thank you, Andy. It's 12:25. I think we have a short time for, I would like to open the floor to a Q&A with a preference for questions in English. I'm sorry, I spoke in Italian. I was requested to speak in Italian. I didn't realize that you didn't get the Italian translation. So I have a question myself, but it's better to start with the floor. One here, one at the end of the room. Uno qui e uno in fondo.
Thank you. Isn't it obvious that the solution is to remove banking from the market, to make banking into a national service that's provided perhaps by the state?
Shall I collect some? Or shall I?
Yeah?
One at once.
One.
Well, that will be one even more radical reform proposal. I think there are proposals short of that which could provide a greater degree of assurance that the banking system should serve the essential social functions that we believe it should serve. So I think, personally, we do have experience of running banking explicitly within the state sector in the past. It hasn't always worked so well. One reason is it's very difficult if you place banks within the public sector, within state hands, for them to be very innovative. And we do want our banking system to be innovative as well as safe. Actually, banking's got a pretty bad record on both. On some measures, the productivity of the banking sector in the US has been little changed for the past century. Imagine that. And for me, it's something of a conundrum, a puzzle, that the IT revolution that has swept through every industry on the planet has not done more to revolutionize banking. Why do I say that? I say that because finance is an information business. That's all it is. And the I in IT stands for information. So in principle, the sector that should have benefited most from the IT revolution is banking. And yet, the payments technology that we face today is little different than what it was 30 or 40 years ago. To the extent that innovation is happening, it's coming not from within banking, but from the encroachment of the big IT companies. PayPal, Google Wallets. So one reason I'd be hesitant about going too far down your path is that it might actually snuff out that embryonic financial innovation, including from non-banks, that I think we all longer term benefit from.
C'è un'altra domanda laggiù e poi No, volevo fare ci sono due mani alzate laggiù, una in fondo e una a metà a destra.
Okay, thank you for your lecture. I wrote a small paper on how to. It's a bit difficult now to put the question. But what I want to say is that until let's say 1950, you had national interest in national banking, and there was, at least in Germany in the past, there was a nobility who accompanied the evolution of growth. And what we then have seen is that big banking overtook probably also the government. Now we face a problem that the Asian countries are growing, they have a national control of their economies somehow, and we don't get back to our investment path just because we have a banking sector who's out of control. And I mean, that's that's something which we realize. But how do we get back to control, given these incentive structures? How do we get back to, I mean, before the glorious revolution, that government debt was private debt by the king. And if things got too difficult, he just repudiated its debt, and he canceled it after 30 years war, after, you know, I mean, you know the history probably better than me. It's just kind of, how do we get back to, because it's a political problem. I mean, we are risking our future because we give too much of our future to the banks. That's a problem. What do you see as points to really reform? Because, I mean, we know these, we can think back to Glass-Steagall, but how do we implement that in practice? That's a problem.
So, as you say, we've gone through a really interesting cycle here, because, you know, taking us back to the origin of banking in this country, 13th, 14th, 15th, 16th century, the boot was on the other foot. So the typical practice then was that it was governments borrowing from the banks, the governments going bust, and then causing problems for the balance sheet of the banks. And the last 200 years, it's been the other way around. It's been the banks stumbling and drawing upon the balance sheet of the government and imperiling both. Whichever way around it is, we need to prize these two things apart. The government or sovereign balance sheet on the one hand, the banking balance sheet on the other. A less large banking sector in relation to GDP is part of the answer to that, because that means the collateral damage in both directions is less when it happens. And I think given the regulatory initiatives in train, that will happen over the course of the next 20, 30, 40 years. But I think in addition to that, we need to think about the incentives embedded within the current system. What was it that kept banking boring for most of its 800-year history? And one of those things, to pick out just one, was unlimited liability. It was that you faced the losses of the risks you took, as well as the gains. The losses weren't capped below at zero and unlimited on the upside. You stood to lose everything if your bet went sour. Now, it's unrealistic, I think, for us to turn the clock right back to one of unlimited liability. But I think we could importantly reshape incentives, for example, in the design and structure of pay contracts, to try and better replicate that unlimited liability world. To give one concrete example of how that might happen, why not require that any bonus paid to a banker is deferred for a much, much longer period, arguably up until the point when they retire. That wouldn't fully replicate the old unlimited liability world, but it would better replicate it than the current structure, which enables people to take their bonus either immediately or within a year or two of having earned it. So I don't have a magic wand solution to your problem, but there are elements that could take us back to the future. I think there's one here.
As I see that we have still several questions, and we have really 5 minutes remain, I would put together all the questions. Please be very, very short, and then just one final answer. La signora qui, il signore dietro, e poi c'è quel signore giù in fondo alla vetrata. Prego, la signora.
Grazie.
Just a moment. Now we have the translation.
Ho bene un marito inglese, ma l'inglese non...
My husband is English, but my English is very poor, alas. I'll try to be very quick and to the point. Do you think that if we really want to avoid these terrible things that we are talking about, we can think that each single state, even in Europe, not to mention, of course, the United States, that basically do what they want. Don't you think that in an attempt to avoid or prevent these economic downturns, states could pass very strict legislation than they have done in the past, both to prevent this excessive growth of banks and to limit their exaggerate growth in income, in profits? And do you think that if one or more banks go bankrupt or have gone bankrupt, this may have been partly, at least, due to the fact that they did not require sufficient guarantees to their creditors in an attempt to increase their profit?
The technology scholars say that the banking system stopped in the phase of process innovation and didn't move enough to the product innovation, which is something similar to what you said. But then there is the good and the bad product innovation. For example, in spring 2008, Gillian Tett, is her name, the anthropologist and journalist of Financial Times, was interviewing some people from the big financial banks, American financial banks. They were saying, one of them, I don't remember which one of the big finance, the three big financial, was saying, yes, we invented the complex derivatives. We are the inventor. We were the first one to make it. But we were meant to put their good things in the package, not bad things. So the imitators put in the complex derivative the bad things and compacted the bad with the good ones. So there was innovation, which was good, but the imitation was bad in that single case.
In fondo alla vetrata.
Sono velocissimo.
You said during your presentation that over the next 20 or 30 years, the strength of banks will have to be played down to some extent. Do you think that this will have a direct impact on real economy, on jobs, and in which sector in particular? We got one more question. I think it has to be the last, because we are really quite late.
Intellectual clarity and in the inspiring presentation. It's good to start the counter-reformation here in Trento. It's good on banking with INET and with the young scholars. The bad news is that the Council of Trent actually lasted for 23 years. So it might take 2 generations of economists, I mean, to reverse that. But the question I would have, I mean, is basically, you've seen the financial world metamorphizing, or, I mean, evolving in through these very difficult times. So I was wondering, I mean, what your advice would be to young scholars in terms of the obstacles to new economic thinking and how to move from thinking to acting newly. Thanks a lot.
Grazie.
Maybe I can take them in turn if I can remember. Remind me if not. So to your question, I was listening and I pressed the wrong button, and I thought it was the sound. It was actually the channel. So I got half of your question in Italian, I'm afraid. So I may not have fully got it. Is more needed? Is more needed? Absolutely. Personally, I'm skeptical. Massimo mentioned this at the beginning, that the solution is to layer extra regulation on top of extra regulation. We've been trying that for the last 40 years, and it tends not to work so well for the very simple reason that the banks can find ways around the system quicker than we can redesign it. So Charles Goodhart, who's a British economist, often used the metaphor that this relationship between banks and regulators was the bloodhounds in pursuit of the greyhounds. We can basically never keep up. They're running much faster than us. I think there's something to that. So if I were to do something of a statutory nature, it would be something to the underlying corporate structure of banking in ways that didn't chase risk around the system, but instead reshaped risk-taking incentives within banks. It could be pay, it could be company law. Banks are, I was discussing this with Rob just last night, they are social institutions. Actually, most firms are social institutions because they touch the lives of all of us. So taking seriously those social responsibilities is key. If that requires a change in corporate form or company law, for me, that would be the right way to go. I very much like the color of your dress, which is the same as the Trento Festival color, by the way. I thought I'd just mention that in passing. Financial innovation, you're right. There's been plenty. It was the wrong type of innovation. The quants, the scientists, the mathematicians, the physicists, they were sucked out of doing what they should have been doing, which was mathematics and science and physics and inventions, were too busy creating rubbish. And that was deeply unfortunate. Could they be redirected onto the path of righteousness? Yes, I think they could. And yes, I think they should. There has been far too little. We need to be mindful of the wrong type of innovation. But I think with the right culture, with the right risk-taking culture, we'd find the right sort of innovation happening. I've forgotten your question, which is terrible. Just remind me very quickly what your question was.
The fact that...
sorry, the get behind you.
Il sistema...
Can you hear me?
Have costs for the wider economy. It need not do so. And the reason is because we don't need banks to do banking. We certainly don't need banks to do lending. The natural holders of long-duration loans, the type of which we might want to be provided to our companies, to our households, to build our schools, to build our infrastructures, are actually not the banks. They are institutional investors such as pension funds and insurance companies. Right now, one of the factors, one of the structural obstacles to growth in Europe has been that it has lacked a non-bank engine for financing the economy. This is an engine, a second cylinder, that the US has, and has been an important contributor to the US recovering more quickly than has Europe. Europe in future needs to place less reliance on banks and more reliance on non-banks when financing businesses and households. If it does that, there is no reason why this regulatory squeeze on banking ought to have any negative effects on the economy. In fact, if anything, this more diverse financial ecosystem ought to be supportive, will be supportive of growth in Europe as it has been in the US. And finally, to the last question, which is 23 years is a short space of time. If we do it in 23 years, you know, I would be over the moon. What direction of travel? The INET young scholars everywhere, and I say this to all of the graduates that join the Bank of England, and I mean it with an absolute passion, that they have no idea how lucky they are to be landing at this point in history, to be facing this set of challenges, not just in banking, but more broadly. There is a real opportunity for that cohort, for this cohort, to make a real difference. Go out and make a real difference. Make a name for yourself. We know events like this do spawn new thinking, do spawn new policies, and do make for better outcomes. That will not come from me. It will come from you. Thank you.
Grazie a tutti per l'attenzione.
Okay, thank you very much indeed for your attention. It's not so common to see the audience so widely involved on such a difficult topic for such a long time. So thank you again.